I can see the gold-silver ratio falling below 30, maybe even falling below 20. This squeeze could really be absolutely enormous. I mean, just greater than anything we've ever seen. China is no longer suppressing the price of silver. It has given up doing that. It's been suppressing the price of silver for a long time. From January, it's been announced by the Chinese authorities that they're tightening up on licensing for exports of silver. We now have a situation where the suppression is ending and consequently prices are going off the charts.
Welcome to the Macroscopic Podcast presented by GoldRepublic. My name is Alasdair MacLeod, and in this format I invite you to look at the world through different lenses to see what's hidden in plain sight. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Well, today I have the pleasure of welcoming, right after the Christmas period, Alasdair MacLeod. Welcome back to the podcast.
It's my pleasure. Thank you for having me.
So, as we just said, it's been quite some time. It's been a very good timing for precious metals investors in the recent weeks. It's felt like Christmas pretty much every day of the month. I would say maybe in 2025 in general. So today I want to obviously speak about this, but I also want to start maybe with the bond market and the outlook for 2026. We've talked about this already, I think, a few times in the past interviews this year. And as things progress, we can see how things start to really break, especially in the case of Japan. You've also talked about this a lot, especially in your recent piece. So what would be for you the single cleanest signal that Japan's bond problem is transmitting into the USTs right now? So if we think about, for example, hedged yields pickup collapsing of maybe a FX basis, what is happening?
Well, it's clear that the Bank of Japan is raising rates. I mean, it's got to. It's as simple as that. And this obviously undermines the carry trade. The carry trade is only just part of it, though, because the other part of it is Japanese institutions, pension funds, insurance companies, going for the yield pickup over their own domestic bond markets by investing in US Treasuries. And Japan is now the largest single category of US Treasury holder. And so as the differential closes down, or in other words, as bond yields start rising in Japan, and we've already got the 10-year, which has gone from negative up to currently significantly over 2%, that I think is going to continue. And I think it will mean that Japanese institutions are not going to, first of all, I think that the pace of their investing in US Treasuries will diminish, and I think they will actually turn sellers at some stage. I would expect that maybe in the not too distant future. The problem that Japan has is that they just cannot stop being Keynesian. I mean, the first thing the new prime minister did was announce a new reflation package. I mean, come on, they're just sort of determined on destroying their own bond market, and that is going to work through. And I think the only thing that's keeping yields at current levels is basically confidence, if you like, overall global confidence that these yields are not going to rise too much more. I can't see anything to stop them rising. I mean, if you get a situation where the global bond scene begins to look sort of more ugly, then I think you could well see the 10-year yield, JGB yield, rising, certainly above 3, above 4, maybe 5%. I can't see what would really stop it once it really starts going. So I mean, the merit that Japan has is it's got a reasonably high savings rate. I mean, Mrs. Watanabe, we used to call the Japanese saver, sort of 40 years ago. She would just tuck away her excess money into the post office, and these savings accounts were tax free, and so that habit is still there, and that's about the only thing actually which allows the Japanese to suppress interest rates below where they should reasonably be. So I can see that. I can see that changing, and of course the impact on America is likely to be very substantial. I mean, for a start, you've got the carry trade arithmetic beginning to work against it, and on top of that, you've got Japanese institutions who are going to be less keen to buy U.S. Treasuries. And of course, that has an impact on the yields in U.S. Treasuries. It has an impact on the dollar's value, if you like, against other currencies. But I think the principal thing is that once this works through and starts pushing up U.S. bond yields, then the equity bubble, I think, will burst. I mean, the yield disparity is already the highest on record. And what I mean by that is the difference between the returns on, if you like, the real returns in terms of earnings and all the rest of it on equities are far, far below the return by investing in a long U.S. Treasury. And if the U.S. Treasury yields are rising, then that's going to just kill the equity market. And I think that's going to be an event I think we're going to see in the first quarter of 2026.
So that's a good point you make here. And before we dive into that, maybe one last question about then other G7 countries, and notably Germany, France also lately. We talked also about the UK a few months ago. How does that look like into the coming months?
Well, we've already seen, if you look at the yield on the long German Bund, that is going into new high ground in exactly the same way as the yields on the Japanese JGBs are going into new high ground. So these low-yielding bond markets are beginning to no longer be low-yielding. And I think so. If we look at it in G7 terms, I mean that's Japan, Germany, and France. The UK, the only reason that sterling is where it is that hedge funds have been buying gilts because of their superior yield. But at some stage, these hedge funds are going to turn around and realize that instead of looking at the greed side of the return in gilts compared with, again, it's a carry trade, really, I suppose, compared with the EU, with the euro, they're going to suddenly see risk. And I think sterling at that point will probably collapse. And I would not be surprised to see our gilt yields at the long end going well over 10%. And of course, I mean, this is effectively a financial value implosion. And it's impossible to see, if I'm right in this, it's impossible to see how equity values will be maintained. So you've got the potential for a crash. And the thing that's driving it, Alex, of course, is the debt bubble. And on the other side of the debt bubble is credit. And the problem we have is that increasingly credit has been created by the banking system to invest in financial assets, predominantly equities. I mean, this is particularly noticeable in the US. And the problem there is that once the debt bubble runs into trouble, with higher bond yields, then, you've got the situation, which is, again, 1929. We've had the roaring 20s so far, both 1920s, 1926 to 1929. And this time, really, from about 2023 to current day. And that's going to be followed by the crash. This is far greater. The equity valuation disparity is far greater this time, with far more credit in terms relative to GDP driving equity values than in 1929. And on top of that, 1929, we had the Smoot-Hawley Tariff Act, which was being discussed in Congress in 1929, enacted in 1930. And we've got Trump's tariffs, which actually are worse in the sense that not only are they putting up prices for domestic US consumers, but the other thing that his tariffs are doing is just creating huge uncertainty because nobody knows what the tariffs actually are. He says they're one thing, and then the next minute he changes his mind. Like he doesn't like you, so he's going to double the tariffs. I mean, this is actually a great disincentive to international trade. So we're setting ourselves up, I think, for a very, very violent 2026.
There, and you've also alluded to that now, talking about the valuation gap between equities and the long bonds, which is, as you described, the largest in history. If yields rise, let's say, another 50 to 100 basis points, what would break first? Would it be passive equity flows? Would it be credit spreads, bank balance sheets?
Good question. I think all of the above. I mean, I think I can't see that it matters which breaks first, really. But I think what we're likely to see is, rising yields will start, if you like, making everybody aware of currency risk. And I think, gold going up through 5,000, I think would probably be as good an indicator as any. I mean, the fact that gold has actually risen in recent months very, very strongly does tell us that gold is front-running a deteriorating situation for fiat currencies, led by the dollar. So further rises in the gold price, I think it sort of confirms it. And what this means is that the great problem in 26 and 27, which nobody really expects at the moment, is soaring inflation. Inflation, prices will be rising very, very sharply because the purchasing power of the currencies is going down. And of course, this isn't in the lexicon of the FOMC in the States. I mean, you read their statements, they hardly ever refer to the quantity of money, the changes in the quantity of money, or indeed the faith in the dollar. That's hardly ever mentioned. But it's overrun by foreigners. And as these events, unfold, I think you'll find that there's going to be massive liquidation of, sort of cross-border investments. But if you look at the foreign interest in the US equity market, is over $20 trillion at the moment. $20 trillion. When that market starts going south, they're going to get the hell out of it. That there is no doubt. I mean, if you look at any relationship between foreign investment and markets in the past, they love it when things are going up, but as soon as things start going down, do they sell their own stuff? No, they hang on to their own stuff and they sell the foreign stuff because the foreign stuff is basically speculation. That'll go. $20 trillion overhanging the market. Now, I don't think the foreigners will get out with more than 10, actually. I think they'll probably get out with probably less than 5 if the market really does crash. Okay, what happens then? The answer basically is that not only does the dollar going down, because if you sell your equities, you're going to sell the dollar as well. And it's worth noting, incidentally, that American investment in foreign stocks, foreign equities, is either in dollars or it's in ADRs, which are dollars. So there isn't American institutions withdrawing from global investment will not undermine other currencies, but it's the getting out of US investments by foreigners which will determine currency rates. And in order to stabilize the situation, the Fed will be in the position where it has no option but to accelerate QE. It will be in there, not only buying US treasuries, not only buying agency debt, not only buying corporate debt, because the refinancing costs for zombie companies are just basically put them out of business. So that's got to be supported. But also, I would not be surprised to see them buying into equity ETFs, like the Bank of Japan has been doing. So the this is going to dilute the purchasing power of the dollar even further. I mean, I think we're looking really at the end of the fiat currency era, I reckon, Alex, and I think that basically means that unless someone does something about it, your currency goes to zero. But the problem is, as we saw with Germany in 1920 to 23, is it's not economic rationale or common sense, if you like, or anything like that determines monetary policy. No, it's politics. Politics, politics, politics. And the politics of it are really quite simple. You cannot do anything to stop the slide in the currencies. And indeed, if anything, your policies make it worse, because the one thing I would see in 26 and certainly in 27 is the introduction of price controls. Now, every politician knows that price controls actually are counterproductive. But does this stop them introducing it? No. They will introduce price controls.
Clear. And I think with that as well, an increase of maybe fiscal policies and in that sense, more taxes, because all that deficit needs to also be financed. Yep. And you see that already happening in France with now taxes introduced for French people living abroad and not being even in the country and using the services. UK, same thing. The Netherlands as well. So there's a lot of that already, like the tell signs about this coming. So my next question would be more related to obviously the merry precious metal feast that we've had in the last weeks. What have been the biggest drivers of this monumental silver and platinum spike? You recently debunked in your newsletter the links between the Fed repos and bank bailouts. Can you maybe elaborate why non-US billion banks are most vulnerable in silver and platinum?
Well, I had a look at the December bank participation report, and there are 5 US banks basically in that report. And if you look at their position in silver, they're net long of silver. Now, we're talking derivatives. We're not talking about physical. The shortage, the bear position, is actually in the foreign banks, or what they call non-US banks, which tells us that, these banks, what they tend to do, and we need to understand this a little bit, what they tend to do is to run long positions in London and short positions on COMEX. So in a sense, it's not too surprising to see that foreign banks are actually short on COMEX. That's understandable. The problem we have to understand is that we're talking about derivatives. Now, the derivative market, in terms of its size, is many, many multiples of what is actually delivered. The further problem we have is that China is no longer suppressing the price of silver. It has given up doing that. It's been suppressing the price of silver for a long time. China is the second largest nation by mine output. Not only that, but she imports masses of silver doré and also other metallic ores, where silver, if you like, is refined out from that. So silver, in terms of global supply, silver is by far the largest entity when you take both mine output and also refinery output into account. From January, it's been announced by the Chinese authorities that they're tightening up on licensing for exports of silver. And what basically the principle behind it is to stop excessive amounts of silver going out of China. They're not stopping it totally, but it will be restricted. Now, this comes at a time when demand for silver is going off the charts, not just photovoltaic cells, not just India, which incidentally has been subsidizing photovoltaic cell production at the government level. So Reliance Industries, for example, one of the very, very big conglomerates, they're building huge, great solar farms, and they're in the business of manufacturing this stuff big time. So they're going into the markets to get the silver, which they need for these photovoltaic cells. But the other thing which is driving it is electric vehicles, and the increase in range and so on and so forth comes really from greater use of silver in batteries. And Samsung have come up with a silver carbon battery, which gives you something like 900 miles, over 1,000 kilometers range. And it takes something like 10 to 15 minutes to charge. That's all. So this is something which is being introduced, I understand, for the more expensive luxury vehicles, EVs, in 2026, and will be spread out from there. Now, the problem is that if you just have 20% of EVs having these Samsung batteries, then that's the equivalent of total mine supply of about 25,000 tons a year of silver. Because one of these batteries uses a kilogram of silver compared with, the sort of conventional lithium batteries taking about 4 or 5 grams. So the demand for silver is going up very, very substantially. The reason that we've got this problem is that suddenly everybody in the industry, if you like, needs silver. They've got to go and buy it. So they're actually raiding the markets. They're going into London and buying forward contracts and standing for delivery. They've been doing this on COMEX more visibly. Stand for deliveries this year so far are about 15,000 tons. So COMEX is, we don't know the number in London quite so much, but COMEX is the largest silver mine in the world, effectively. It's the largest source of silver. So, by a long, long chalk. I mean, if you're looking, I worked it out, something like 58% of mine production is actually being stood for delivery on COMEX. This is just staggering. So it's not surprising that the price of silver is going through the roof. I mean, the other point worth making, Alex, is that we tend to look at these things as investors in regulated investments. Now, if the price of, let's say Microsoft or Nvidia or whatever goes up, then we know that it will rise to the point where sellers come in, because you've got buyers and sellers there the whole time. They're not all the same way. Okay, they like to ride a rising market, and more buyers will come in on the rising market. But at some stage, you will find that sellers will take profits. And so there will come in some supply. Price rises to the point where supply comes in. This is not happening with commodities, for the very simple reason that you don't have that depth, if you like, of investor interest. These are non-regulated investments. They're not in the investment pool at all. It's purely industrial. So any hedging there is from industrial sources. So if you look at mines, for example, traditionally they've been the ones that hedge production because, they've got the bills to pay and all the rest of it. And if they get a price for silver, they don't want to find that the silver which they extract over the next quarter buys less than it does today. So they would hedge their production. What do they do now? I mean, they've got no interest in doing that. It doesn't make any sense. They see what's happening. They know that China has stopped supplying the West. They know that prices are going higher. So what do? Mine? No, I'm not going to hedge I'm just going to ride it. I mean, why not? And not only that, but now we are actually profitable at these levels, and consequently, we don't need to hedge future production. So this throws the emphasis back on the swaps, the bullion bank trading desks, in order to try and keep, if you like, keep the price down, or to take profits if they happen to be net long. But they don't want to get into the situation where they're even more short, because basically they are short on COMEX. And the problem in London is they may well be long on London, but people are standing for delivery. And as they stand for delivery, they reduce the amount, if you like, of outstanding contracts, because someone standing for delivery, who has bought, in other words, let's say a bullion bank has sold forward delivery of 1 million ounces or whatever, they will have covered themselves on the other side. So equally, someone who is long will find that, really, the market is contracting on him and he can't cash it in. He won't find a buyer for his long position because the entire market is contracting. The entire derivative market is contracting. So this lack of liquidity is really what's driving the whole situation. And I think that the fallout from the Chinese situation has only just started. It really has. It's an unusual event, but it does happen from time to time. And I think the other thing behind it is that decades of fiat currencies have distorted the entire commodity scene so much. It's had the effect of driving commodity prices down in real terms while they appear to be rising in dollar terms. It's because the dollar is not rising fast enough. The dollar price isn't rising fast enough to account for the depreciation of the dollar. Consequently, if you look at copper in particular, which is another must-have metal for the same reasons as silver, the price measured in gold is roughly 18% of where it should be in terms of long-term value. So that means that even priced in gold, copper is likely to increase by 4 or 5 times. So what does that do to the price of copper in dollars? Well, through the roof. And as the markets begin to understand this, the supply of copper is going to into markets is going to diminish. We've already got a battle royal between America and China over the Democratic Republic of Congo, and also in Zambia, which is the major copper producing center in Africa. So, and China, I understand, is the largest refiner of copper. If China puts that on the restricted list, then I think it's going to be, people will wake up, I tell you, they really will wake up.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth.
So yeah, what one could say that's the innings of the first, let's say, actually real geopolitical resource war between those big countries, and that all of the things that the Trump administration in particular has been preparing us or announced with the Strategic Minerals Reserve Act and these kind of things have been just a preparation to that. But I want to maybe conclude with that then at the end of our conversation. But first, I would like to know about what you think about the current CME futures margins that rose about 4% of notional. So that was about 25 times leverage. That was in 2011 to around 10%, which was about 10%, 10x leverage over just a few weeks. Which then triggered a cascade of liquidations among speculators and ended the price rally. And today, margins are already approximately at 17% in notional value, so about 6 times the leverage, which is tighter than the worst parts of 2011. So now I'm wondering, because I've also read an article about this by Anthony Campbell, that argues that further margin hikes from here wouldn't flush out speculative positions due to the limited leverage left, but would instead impact hedgers like producers and refiners who rely on the market for risk management, potentially leading to reduced liquidity, wider spreads, and commercial activity, shifting OTC markets. So that's what he wrote. So I was thinking, or I was wondering, what do you think of the current situation, if it's fundamentally different than 2011, and have the mechanics indeed flipped this way or not?
Well, I mean, COMEX margin requirements, I think, do make a lot of sense if they increase them in this environment. And I would expect them to continue to increase them. And yes, it does actually affect things, because it's not just the longs, if you like, but it's also the shorts. So you find that the shorts get squeezed in this environment. I mean, the silver market is one where there is actually very, very low participation by speculators. Just look at the open interest. It's around about 150,000 contracts. I would say that the normal level is probably around about 170,000 contracts as an average over time, maybe a little lower than that. But this is not, a market which is driven by speculation at all. So when the margin requirements are increased, it doesn't hit the speculators so much; it hits the establishment. So, it hurts the bullion bank traders, the swaps, that category in particular. I think it's an interesting point that it's a further discouragement to miners hedging. I can understand that. I think as far as industry is concerned, they don't care too much about this, because they're in there buying silver, basically, by stand for delivery. That's really their interest. But it's all part of this tightening up the market. I mean, there was someone who put out a thing the other day about how the increase in margin requirements on COMEX was hitting the big US banks, and consequently the Fed had to step in with repos of around about 17 trillion. Sorry, 17 billion, not trillion, 17 billion. Now, actually, if you looked at the numbers, I mean, there's complete nonsense, because it's not the banks who are short. They're actually long of silver derivatives. It's the non-US banks, the 17 non-US banks, which are short. And of course, they're long in London. So, I mean, and, the Fed, this was on Christmas Eve, the Fed producing, repo, intervening in the repo market. I mean, the reason they intervene in the repo market is basically to hold the rates within their target range. And we've got a year end. You've got all sorts of factors which might mean that banks need overnight finance to ensure that their books are square. And it's not just silver, for goodness sake. It's, it could be everything. It could be interest rate swaps. I don't know, whatever, bond positions and so on. So, and also bond failures too. This is the other thing. Fails to deliver. Apparently, they've risen quite significantly. So, I think the point about increased margin requirements on futures and options, I think we must expect that with this volatility. It's not a bad thing. COMEX has to do it in order to protect itself, because COMEX is standing there taking the counterparty risk for everyone. So it's got to manage this properly. It's not like an over-the-counter market, like in London. The LBMA market is over-the-counter, where it's principal to principal. So you've got counterparty risk is a big, big issue. It's not an issue for people trading on COMEX, unless, of course, the widespread defaults and COMEX takes it on the chin, and COMEX has to somehow fund it and all the rest of it. That is actually what the great taking is all about. How COMEX will have available, if you like, all the collateral it needs in the form of ETF shares, in this case, which are owned by the DTC. So, that is something which can be dealt with. So I think, we're going to see more and more margin increases, I think, until the volatility declines, if it does decline. So to my mind, it's not an issue. We should expect it.
So now if we look at also the price action of platinum, it spiked tremendously, and a lot of platinum investors have been kind of prepared for the setup for a couple of months at least. I know that there's been a lot of chatter about that, and now it's finally paying off. Often gold leads and then silver follows, and some would even say then platinum follows. Would you then say that this is then the beginning of like even bigger price appreciation? Have we maybe just topped into this kind of sequence, or where do you see prices going from here?
Yeah, I mean, basically, it's even less liquid than silver. And so you can get the thing mispriced hugely. I mean, bear in mind that with all these commodities, people buy and sell them. I mean, mines and industrial users and governments and so on and so forth, without going through the market. They just refer to the market, which is why they quite like to use derivatives to control the price. Because if you can suppress the price, and then you're going to take delivery of, say, 50 million ounces of something, then that it suits you to suppress the price. I mean, this is really one of the ways in which derivatives are being used. So consequently, the price can go quite adrift from the real supply and demand factors in any particular metal. And I think this is particularly the case with platinum and palladium. I mean, just amazing how volatile they have been. But now, of course, they're getting caught in the squeeze. And I would say, as a general background, base metals are wildly undervalued because of the distortions from a collapsing value of the dollar. And so they're all prone to this problem one way and another. And I think what we're seeing is platinum and palladium and silver are the standout issues, if you like, currently in financial markets.
So what is your outlook now for 2026? Do you expect this run overall in precious metals to continue? So are we mid-peak? Where are we at in the cycle?
I mean, gold basically is telling us quite clearly that the purchasing power of the dollar is not only declining, but it's going to continue to decline, which means that gold will continue to rise. Silver is telling us that, and also platinum group metals, is telling us that they have been suppressed. We now have a situation where the suppression is ending, and consequently prices are going off the charts, and they will continue to do so until I don't know when. I mean, basically, I can see the gold-silver ratio falling below 30, maybe even falling below 20. I mean, this squeeze could really be absolutely enormous. I mean, just greater than anything we've ever seen. I expect bond yields to rise next year. The ending of the carry trade and also the reversal of global flows out of low-yielding major currencies into higher-yielding major currencies. I think that's going to be a factor. And I think as that happens, the equity bubble, the debt come equity bubble, will collapse, implode. And I expect QE to just take off, because what alternative does the Fed have? So all this in 26 tells me that we're going to see inflation unexpectedly rise very significant and leave the post-COVID inflation spike, leave it in the dust. I think it's going to be a lot worse than that. And of course, this will push bond yields even higher. It will push the price of gold even higher in these collapsing currencies. I just see it as really all symptomatic of the end of the fiat currency era, which has been running now for 54 years.
All right. On this note, Alasdair, thank you. Thank you for your time, for your precious knowledge that you've been sharing and warning investors for many, many years. And now it's coming to fruition, I think. And many people appreciate that. Obviously, for those who don't know, but I guess that's a very big part of the audience here, Alasdair has a newsletter on Substack that you can follow, and he's also very active on X. So I thank you again, Alasdair.
That's my pleasure, Alex. Thank you for having me.
Have a great day.
And you.